approaches and methods of valuation. So ultimately, what do we need? We need to learn the approaches and methods of valuation. Now, once we learn these approaches and methods of valuation, then what we need to do? We need to apply these methods and the approaches depending on the situation. So it's not that there are situations that would require income approach. There are situations that would require the market approach. There are situations that would require the cost approach or the asset approach. There is nothing of that sort. In every situation, as a valuation professional, you will need to apply your mind. You will need to think as to what should I do? Which approach should I use? And within that approach, which method should I use so that I am able to find out the fair value? Remember, your focus has to be on the fair value. So your aim and objective is to find out the fair value. And for finding out the fair value, whatever you have to do, you should do. It is as simple as that. Now let us look at which are the approaches for the purpose of valuation. So the first approach that you have for the purpose of valuation is income approach. As you can see, the name suggests income approach. That means under the income approach, what is the basis that you use for the purpose of valuation? The basis that you use for the purpose of valuation is the income, and that is why it is known as income approach. As simple as that. Under the income approach, you got two methods. You got income capitalization method and you got discounted cash flow method. What is income capitalization method? How do you find out value of a business or a company or an asset using the income capitalization method? So what you do, you find out income of the company for which you have to do the valuation for last 3 years, 5 years, 6 years, 7 years, as you will think appropriate in your wisdom and understanding. Now what you do, having determined that you need income of last 5 years, so you pick up last 5 years income. Now you normalize it. What is the meaning of normalization? The meaning of normalization is that in these 5 years, you will need to find out, are there certain income which are exceptional in nature? Are there certain expenses which are exceptional in nature or non-recurring in nature? So what you need to do, you need to pick up all such incomes which are exceptional or non-recurring. So what you do, you remove those income from the income of that year, and that is what is known as normalization. Likewise, there are certain expenses which are non-recurring in nature. So again what you do, remove those expenses, because these are the expenses that are not going to happen every year. So this is what is known as normalization. So what you do, you find out the normal profit of last 5 years, find out the average profit of last 5 years, and now what you do, you capitalize this profit by your cost of capital. So let's say for example, you arrive at the profit of 100 crore, average profit of 100 crores, average profit which is normalized average profit of last 5 years coming 100 crore. And let's say your cost of capital is 10%. So what you do, you divide 100 crore by 0.10 and you get a figure of 1000 crore. That means using the income capitalization method, value of this business is coming to 1000 crore, and that is your income capitalization method. And this is how you will find out the income, find out the value using the income capitalization method. Then under the income approach, you have discounted cash flow method, DCF, which of course is globally used method and globally used extensively for the purpose of valuation. In my view, discounted cash flow method is the best method for the purpose of finding value of any business, because discounted cash flow method is the only method that takes into account is one method that takes into account income income or the cash which is generated from the business and for arriving at the value. And please remember, ultimately what is value of a business? Value of a business is nothing but its ability to generate the cash. So that is a discounted cash flow method. We are going to discuss DCF in much more detail as we move forward. Also solve few case studies on discounted cash flow method. Then you have the second approach, which is market approach. And you can understand market approach. That means what? That means under the market approach, you use the market information for finding out the valuation of an asset. So using market information for finding out value of an asset is market approach. So under the market approach, there are two methods. The method number one is comparable company method, and method number two is comparable transaction method. Meaning what? Meaning, let's say for example, there's a company called XYZ. XYZ is what you need to value. So what you will do under the comparable company method, you will try and find out, is there any company which is similar to the company for which you are doing the valuation? Let's say XYZ. So you have to do the valuation of XYZ, and what you will do, you will try and find out if there is a company which is similar in nature and every other aspect, say as XYZ, and if this company has been valued recently, or you will find out as to what is the value of such a company. So assuming that both these companies are same or similar in many ways, the presumption is if both these companies are similar, then the value of both these companies should also be similar. So you want to find out the value of XYZ. There is a similar company available called ABC. ABC has been recent past valued at 50 crore, and so that 50 crore becomes the basis for you to use as the basis for doing the valuation of XYZ. Of course, you will need to make certain adjustments for the differences that may be there between company ABC and XYZ. So that is your comparable company method. That means you are trying to compare one company with another company for finding out the valuation, and that is your comparable company method. Then you got a comparable transaction method. So in case of comparable company, you try. Yep.
Sir, this comparable company method, what I understood that we have to compare the same company in a same industry, same company.
Yeah.
Which means all like a size, it may be a capacity, and in terms of
product,
a product,
technology.
Yes, technology, all these things. Sir.
Yes.
But though if you compare also, that company may perform well, they may do a cost reduction program so that the profitability may increase also. But these company may incur more cost, the profitability may these things, and they would have their marketing skills may be super than this company. So how we can analyze and compare it, sir? It is difficult, no, sir?
Yeah. Yes.
In practical way.
Yes, Sukumar. It is difficult. It is difficult, and that is why valuation professionals. It is difficult. That is why valuation professional. So what the valuation professional will need to do in such a case? So for the purpose of doing the valuation of XYZ, he will need to find out a similar company as a company XYZ. He finds out the company which is ABC, which is more or less same as company XYZ. So now what the valuation professional will have to do? The valuation professional will have to find out the reasons for the differences between these two companies. So as you said that one company may have deployed the cost reduction, one company may be more aggressive in marketing. Now, so first you take the value as the starting point for XYZ, which is same as the value of ABC. Now, in this value that you have picked up of ABC, you start making adjustments for good points which are available in company XYZ, and you add them, and adjustments for negative points. That means good points of company ABC which are not there in XYZ. So as a valuation professional, you will have to use your judgment. You will have to use your judgment, and not only use your judgment but document it also. So you will need to find out company, I'm doing the valuation of company XYZ, and company ABC has been done valued recently, and the company ABC has been valued at 100 crore. More or less both these companies are similar, and that is why the starting point for the valuation of XYZ is 100 crore. Now what you do, find out the reasons of differences between these two companies and convert those reasons of differences between these two companies in terms of money value. Make the adjustment of those money values in that 100 crore figure that you have taken. So keep on plussing and minusing, plussing and minusing, plussing and minusing for the differences between company ABC and XYZ. And at the end, after making all the adjustments, you will get a figure. So that becomes the value of company XYZ, which is based on comparable company method. I hope that makes sense to you.
Super, sir. Great, sir. Thank you, sir. Thank
Very good. Okay, then you have comparable transaction method. So there's only small difference. In case of comparable company method, what you do, you try and find out a comparable company. In case of a comparable transaction, what you do, you try and find out a comparable transaction. So let's say, for example, you are moving from Chennai to, let's say, Mumbai, right? And let's say, for example, you are moving for good. So you are looking to purchase a new house for yourself in a particular area. So and you are new to Mumbai, so you do not have much idea about Mumbai, but you still have to buy a new house for yourself. So what you do, how, and you are getting good references, good houses, but the question will come to your mind: how do I determine the price? How do I determine the value? How much should I pay for a new house in a particular area? So what you will do, you will try and find out through your contacts as to if a similar kind of a flat has been sold in that area in the recent past. So you will find out, and that becomes your basis for the purpose of the price that you should be prepared to pay the new house in that area, and that is comparable transaction method, right? So that's your comparable transaction method, right? So that's your income approach, market approach, and now we come to the asset or the cost approach. Now please remember, invariably for the premise of going concern, you will use the income approach and you will use the market approach. For the premise, when the valuation is to be done, and if the premise is liquidation, invariably you will use the asset approach, or which is also known as cost approach. So under the asset approach or cost approach, there are four methods. The method number one is book value method. So what is the meaning of book value method? Very simple. You pick up the balance sheet of the company, and from the balance sheet of the company find out the value of all the assets that it has, minus from the total of all the assets the company's balance sheet is carrying, all the liabilities that the company's balance sheet is carrying other than the net worth of the company, and the difference that you arrive is the book value of that company. It's as simple as that. So book value is value based on the books of the company, and that is why it is known as book value. Then you got a second method, which is adjusted book value method. Now what is the meaning of adjusted book value method? So in case of book value method, what you do, you pick up the values from the books and take them as it is and find out the value of the asset. Now in case of adjusted book value, what you do, you pick up the value from the balance sheet, but you don't take them as it is. Instead of that, you make adjustment. For example, the land may be reflecting in the balance sheet at 1 crore, but you understand that this land was purchased by the company 20 years back at 1 crore. Today, the value of this land is not 1 crore. Today, the value of this land is 50 crore. So, under the adjusted method, what you will do, for the land, you will not take the value to be 1 crore. You will take the value of the land to be 50 crore. And likewise, you will pick up all the assets items and you will pick up all the liability items and find out as to what is the current value of those assets and the liabilities, and that becomes your adjusted book value. Then you have a replacement method. So what is the replacement method? Replacement method is as is what it is. That means if the asset which I am trying to value, if this asset is to be replaced in the same condition as it is, not the new one. It is not to be replaced with a new one. It is to be replaced as it is. So if it is to be replaced as it is, then how much is it going to cost me? And that is your replacement method. And finally, the fourth one is liquidation value method. That means what? That means if this company has to be closed, all the assets are to be sold, or the liabilities are to be discharged. So if all the assets are sold, how much money will I receive? Minus how much expenses I would incur in in selling those assets. That becomes the net realizable value of those assets. And from the net realizable value, I will minus all the liabilities that I need to discharge, and whatever remains in the bottom, that is my liquidation value. So friends, this is how it is. So these are the three income approaches for valuation: income approach, market approach, and the asset approach, and different methods under these three approaches. Now, as a valuation
Sir,
profession,
one,
please go ahead.
sir, among this method, the asset approach, what we want out, sir, this replacement you are saying, no, sir.
Yeah.
Book value method understood, sir. Adjusted also, okay.
Hmm.
Replacement means, and this asset also predominantly we are using in the liquidation premise,
Right.
not another vehicle, sir.
Right.
So in that liquidation replacement, how it is when we will be using, sir?
Right. So
Replacement.
when
What situation?
yeah, I will. When you insure your car with the insurance company, and let's say unfortunately the car meets with an accident and it is damaged. So when it is damaged, what the insurance company does? Insurance company does not pay you for the new component.
Yes, sir.
Insurance company pays you for the replacement component. So that means if let's say if the door is to be removed,
Yes, sir.
so what the insurance company will say, insurance company will find out how much is the cost of the new door. Let's say 30,000. Now insurance company will not pay you 30,000. Insurance company will pay you only 15,000. 15,000 you will have to pay from your side. So what insurance company is doing? Insurance company is giving you replacement value. Replacement value on as it is basis. Do you get this, Sugmar?
Yes, sir. Understood.
That's your replacement value. That's your replacement
Thank
value. Yeah.
thank you.
Very good. Now we need to understand one more thing, and as to which is a good method. Is it the income method, or which is the best, or the market method, which is the best, or it is the asset method, which is the best? If you ask me, there is nothing of this sort. But what we need to remember, income approach is most fundamental, dependable, and reliable. Ignore at your own risk. So whenever you have to do the evaluation,
Yes, sir.
and the choice is in your hand. So when I say choice is in your hand,
Yes, sir.
that means, if you have to do a valuation of a company which is listed on a stock market, for the listed companies on a stock market, SEBI has given the guidelines as to how the valuations are to be done in different approach situations. And SEBI incidentally or focuses on the market price. So SEBI will decide the value based on the market price. So that's in case if you have to do the valuation of a listed company, you will have to do the valuation mostly in most cases based on the market approach. But otherwise, if you ask me, valuation is always better on cash or income approach. Why income approach? Because ultimately the value of any business lies in the income, the future income. So that is what we need to remember. Most fundamental is the income approach.
Sir, here you are telling this. Uh, shall I ask, sir?
Yeah, please go ahead.
Sir, you are telling this SEBI listed companies have to take it a market price for the value.
Yeah, the quoted prices.
I have, quoted price, sir. I have one question on my mind, sir.
Mm-hmm.
Always this market is very sensitive of information and price sensitive. Sometimes it may boom like anything. Sometimes it will come down. So how this market price is actually a correct thing for taking for a valuation? Sir?
Yeah, good.
Because it is.
Yeah, good point, and very valid point. So, to take care of this concern that you have just expressed, what SEBI has done, SEBI has given the guidelines where value is to be picked up not on the date of the transaction. The value is to be based on the high and low of 26 weeks or 52 weeks, or different situations, different periods have been specified. So it's not that the valuation is going to be based on one day's price. No, it's going to be based on the price of number of days, and based on the different situations, SEBI has specified different parameters. So that will take care of the concern that you have.
Yes, sir. Sir, just for the discussion purpose, just want to quote one example, sir.
Mm-hmm.
If you take this Ruchi Soya and all, this price is going like anything, sir. Even for a year, and the thing also, the price will be like in. But if you're going to value the company, no, because their market is factoring that future is good for the company.
Right.
The cash flow, the earnings will be like anything like that. Situation also may like that happen, sir.
Right.
Blindly this 26 weeks or something like that, is it correct, sir, as per your point of view?
Yeah. So no, that's a good point that you have mentioned. But remember, why do you do the evaluation? You do the evaluation for the purpose of decision making.
Yes, sir.
And it is a non-fact that valuation is never static.
Yes, sir.
Valuations are going to be changing all the time.
Yes.
Right? And
So you
therefore,
have to make assumptions.
you have to make assumptions. Valuation that you will work out, whether based on the market approach or the income approach, they will only give you reference point or starting point for doing a deal. You will have to make a lot of adjustments as you may deem fit. So if you find out value of a business as 100 crore, it is not necessary that your client will sell it for 100 crore. Your client will get an idea that my company should be sold at least for 100 crore. So he will try and market it even at a higher price. So this is how it is. This is how it is. Okay. Market prices are basically quoted prices, and it is good as a cross check of the income based valuations. And as far as the asset or cost approach are concerned, it is basically good for liquidation premise. So the asset approach or the cost approach invariably will be used for the purpose of liquidation.